Hello guys, welcome back to Ride Academia. We are still on our series on the partnership account, and today we'll be looking at the revaluation account. All right, the revaluation account is another account that is open in the partnership, although it is not opened regularly. Okay, when we talk about revaluation, we're talking about either the we are talking about the review of assets. It could be the upward review or the downward review. Okay, we are trying to revalue asset. That's why it's called a revaluation account. All right, so it's either we revalue the asset upward, or we revalue the asset downward. That is, we increase the asset value or decrease the asset value. All right, now we are going to be preparing, or we'll be learning how to prepare the revaluation account in today's video. All right, now like I said, for the goodwill, the revaluation account also have certain situations that may warrant the preparation of revaluation accounts, such as the admission of a new partner. When a new partner is admitted into the business, when we have a change in the profit sharing ratio, okay, and then also when a partner retires or a partner dies, okay, that a partner is leaving the business, then we may need to revalue asset as well as goodwill. Okay, so in this video we are going to be understanding how to treat assets or how to revalue assets. All right, now there is an account that we call, before we start any illustration, there's an account that is called the revaluation account. So there's an account that is called the revaluation account. Okay, that revaluation account is opened whenever we see the need to revalue assets. Okay, a revaluation account is open. In other words, if there's an increase, if we are revaluing the asset upwards, as we debit, because every asset is a debit item. Okay, so increase in asset is going to be debited, then decrease in asset value is credited. Okay, so as we debit asset value, if there's an increase in the value of asset, or if we are reviewing the asset upward, asset value upward, then we debit the asset and be crediting this revaluation account. All right, and then if we are reviewing our asset downwards, like I said, you'll be crediting the asset account and then be debiting the revaluation account. All right, so at the end of the revaluation, or after we are through with revaluing all the assets under consideration, we will now share the profit or losses on revaluation. That is from the revaluation account now. Okay, we share the profit or losses from the revaluation account following the old or the already established profit sharing ratio, the old profit sharing ratio. Okay, in the case of change in profit sharing ratio, we have to share the profit or losses on revaluation based on the old profit sharing ratio that was established by the firm. All right, now today we're going to be like in our, when we were treating goodwill, we consider that situation where we have the admission of a new partner. Okay, now for the case of revaluation account, we're going to be treating another situation that may warrant revaluation or goodwill at the same time, which is when a partner retires or when a partner leaves the business. Okay, so we're going to be taking an illustration that has to do with a partner that is retiring, and then we'll see how we value goodwill as well as revaluation accounts. All right, so we have an illustration before us, right? We have that Fumi, Remy, and Titi were partners in the fashion business. They have been sharing profits in the ratio 3:2:1 respectively. Okay, Titi retired from the partnership on 31st of March 1991. Okay, and then goodwill of the firm, which had not been previously recorded. Okay, it has not been recorded in the books of accounts, but now is to be valued at 6,000 naira. Okay, so we are valuing goodwill afresh. We know what we have treated goodwill in our previous video, so we're going to be using exactly what we have said, okay, to treat goodwill even in this video. So goodwill was valued at 6,000 naira, and then the asset of the firm were revalued at the following amounts. We have that land and building to be revalued at 18,000 naira. We have that furniture to be revalued at 3,000 naira. We have motor vehicles to be revalued at 4,500, and then lastly debtors to be revalued at 4,100. Okay, so when we want to revalue assets, we simply match we check for the balance sheet value. Okay, we check the value at which that asset was recorded in the balance sheet. Okay, and then we compare with the revalued amount. The new amount now is that amount that was given to us as the revalued amount. All right, so we'll compare the balance sheet value and then the revalued amount. which is higher or which is lesser. Okay, in that's what we're going to be using to work with our to work in our revaluation account. All right, so we're going to be using this, and then our balance sheet is given to us. All right, so like we're saying, this is the second situation where a partner is retiring. All right, a partner is retiring, okay, on 31st of March 1991. So we're going to be using this information. Like I said, we're going to be opening an account called the revaluation account. All right, and then for every increase in assets, we'll be crediting our revaluation account and debiting our asset account. And then for every decrease in assets, we're going to be debiting the revaluation account, and then we'll be crediting the asset account. All right. All right, so it is worth remembering that the revaluation account also have a direct impact on the capital account, okay, on the partnership capital account. So after we have done the total revaluation, we then share the profit or losses in the agreed ratio, and then credit or debit the partner's capital account when necessary. Okay, so we're going to start with the goodwill account. Okay, that's going to be easy because we have done something on goodwill. So we're just going to quickly look at the goodwill account, and then we'll move straight to the revaluation account. All right, so for the goodwill account, we have agreed that they are sharing profit and losses in the ratio 3:2:1. All right, like I said, goodwill, when it is valued fresh, if we use the old profit sharing ratio, okay, which is 3:2:1, and then our goodwill value is 6,000 naira, that automatically means for the goodwill account. Now, since goodwill is a debit item, right? Since goodwill is a debit item, it means that for we'll be entering on the debit side in the goodwill account, then be crediting the capital account. All right. So our profit sharing ratio is 3:2:1. So when we add, if we want to convert to fraction, when we add 3 plus 2 plus 1, we are having what? 6. So for the first person, which is Funmi, okay. Now, Funmi is going to be having, for her share of goodwill, which is 6,000 naira, right? Funmi, since she's the first person carrying the first ratio, which is 3, okay, like I said, we are converting to fraction. So we're going to be having 3/6. We got 6 by summing all the ratios together, okay? So for the first person, we are having 3/6, which is Funmi. 3/6 times our goodwill value, okay, which is 6,000 naira. And then that will be giving us what? 3,000 naira. All right, now for the next partner, the name of the next partner is Remi. Okay, for Remi is coming with is going to be taking the second ratio, which is 2, and then converting to fraction, we have over 6. Okay, so Remi is going to be getting 2/6 times 6,000 naira, which is 2,000 naira. And then the last partner is Titi. All right, so Titi is getting the last ratio, which is 1/6 multiplied by 6,000 naira, and that'll be giving us 1,000 naira. So this is our goodwill value, right? This is our goodwill value. Now, since goodwill is not written off, okay, we're not given any information that goodwill is going to be written off. So this goodwill, it means it's going to be retained in the book. All right, so we're going to be bringing in our balance carried down. We're no longer closing the account. Okay, so we're bringing in our balance carried down for goodwill, which is 6,000 naira, and then to balance the account. Okay, after we have our balance carried down, it means we'll be having our balance brought down of same 6,000 naira. Okay, same value with our balance carried down. Now we are through with our goodwill account, although we are left with crediting the capital account. All right, we are still going to credit. When we get to the capital account, we'll be bringing this goodwill value to credit. Okay, now the next thing we're going to be doing is the revaluation account. Like I that's our work for today. We want to look at the revaluation account. So like I said, when we want to revalue assets, we look at the balance sheet value of that asset, the value that was given in the balance sheet. We use it and then compare with the revalued value. Okay, that revalued value of the asset. Now, for the balance sheet, we had that land and building is 10,000 naira. So the value of the assets as given in the balance sheet is 10,000 naira. Now they are asking us to revalue land and building to be 18,000 naira, no more 10,000. That means there's an increase. All right, there's an increase in the value of the land and building by 8,000 naira. So we'll be entering. It means if we have a land and building account, let's just say L and B, okay? If we have a land and building account, we already have a balance brought forward of 10,000 naira. All right, this is a rough work. We have a balance brought forward of 10,000 naira, and then we are revaluing. That means we are adding. So we are revaluing what 8,000 naira, so that our assets can now be up to 18,000 naira. All right, so it means we are debiting the land and building account with 8,000, so we can having a total of 18,000. Okay, our focus is on the revaluation account, right? We are going to be crediting our revaluation account for land and building. So this is how we revalue, okay? For land and building, we're going to be bringing in 8,000 naira. All right, we're going to be bringing in 8,000 naira for land and building, okay? So that we can have, like I said, once you are crediting this account, it means you are debiting the land and building account, okay? So that we can increase from 10,000 naira to 18,000 naira, okay? Then for the next one, we are having furniture. The value that was given in our balance sheet is 4,000 naira. All right, that means furniture account. Furniture account will be having a balance brought forward, okay, of 4,000 naira. This is still a rough work, okay? And then the revalued value is, they're telling us to revalue furniture to be 3,000 naira. That means there's a decrease in value, right? And that means our difference is 1,000 naira. It's a decrease, okay? So it means for us to get 3,000, we have to subtract 1,000 for revaluation, okay? 1,000 naira, so we can have a balance of 3,000 naira. Like I said, whenever we want to subtract in the ledger, we counter enter. All right, we counter enter so that we can be subtracting, and then when we want to add, we enter on the same place, okay, so that we can be increasing the value. So whenever we counter enter, we are subtracting. Now for counter entering, it needs to be debiting. For every credit entry, we have a corresponding debit entry. So we're going to be debiting our valuation account for furniture for 1,000 naira, okay, which is our difference. All right, not the new value but just the difference. All right, and then we have motor vehicle. Now the value given for motor vehicle in the balance sheet is 6,000 naira. Okay, the value given for motor vehicle in the balance sheet is 6,000 naira, and then the revalued amount is 4,500. That means we still have a decrease. All right, we still have a decrease, and the difference there is what we are focused on. Okay, so the difference between 6,000 and 4,500 is 1,500 naira. All right, so that means we'll be entering in on our revalued account, like this is a decrease. Okay, so decrease in assets will be debited on our revaluation account. All right, ledger. It means our motor vehicle account, okay, this is our rough work. Motor vehicle account is having a balance brought forward, okay, of 6,000 naira. And since we are subtracting, like I said, we want to arrive at 4,500. That means we have to subtract. That amount we are subtracting now is what is coming to the revaluation account. All right, the difference is 1,500, so that we can arrive at a balance of 4,500. All right, so we'll be entering in the revaluation account for motor vehicle. We are having 1,500 naira. All right, so that we can arrive at the new amount, which is 4,500. And then lastly, we have debtors. Okay, we're also revaluing debtors. Every other account that is not revalued will remain the same, okay, but the revalued account is going to having a different balance. All right, so debtors from the balance sheet, we have 4,800, and they're asking us to revalue debtors to 4,100 naira. All right, so our balance sheet is containing 4,800, and then the revalued value for debtors is 4,100. So we want to revalue. Now this is a downward, okay, because it was 4,800, now it's going to come to 4,100. So we're going to be having a difference of 700 naira. So that is still a decrease in asset value, okay. And then quickly, decrease in asset value will also be what? Debited. We are having debtors. The difference we are having is 700 naira. All right, so we are debiting 700, not the entire amount, just the difference, okay, which is 700 naira. So this is all the asset that were revalued. In that case, we can now balance our account, and then we'll take the profit or losses to the partnership capital account using the old profit sharing ratio. All right, all right, so to balance our account, what we do is that we check our debit side total and then our credit side total, and then compare which side is higher Balancing our account means we want the both balances, we want the total to agree. All right. So for the debit side, we are having a total of 3,200. All right. For the debit side, we are having a total of 3,200. All right. And then for the credit side, our total is just what? 8,000 naira. All right. That means our credit side is higher. Okay. Our credit side is higher than the debit side. And then what we are going to be using to balance the account is the difference. Okay. So 8,000 minus 3,200, we are having 4,800 naira. All right. Which is the amount we're going to be using to balance our account. But like I said, we are balancing this account by transferring the balance in to the partnership capital account using the agreed profit or loss sharing ratio. Okay. So we want to balance this account. That means we'll be using this 8,000, 4,800. We'll be sharing it in the agreed partnership sharing ratio. Okay, which is 3:2:1, like we did for the goodwill, right? So we're going to be sharing 4,800 for the partners in the agreed profit sharing ratio, and then we'll be taking that amount to their capital account. Okay. So for the 4,800 naira balance for the first person, like I said, to convert to the fraction, we are having 3 plus 2 plus 1, which is 6. Okay. So for the first person, which is Fumi, the first partner, Fumi is going to be having 3/6 times 4,800 naira. All right. She's going to be having 3/6 times 4,800 naira, which is 2,400 naira. All right. Now for the second person, the second partner is Remi. We are sharing this 4/8 balance. Okay. So for Remi, we are going to be having her own ratio is 2. Okay. So we are going to be having 2/6 times 4,800 naira. All right. So we're going to be having 1,600 naira. And for the last partner, which is Titi, okay, her own ratio is 1. So we are having 1/6 times 4,800 naira. So we are going to be having 800 naira. All right. So this is means we have balanced our revaluation account. Okay. So that when we add both sides, we should be arriving at the same value of what? 8,000 naira. Okay. Which it means we have balanced our account. And that also means we are going to be transferring this balance, okay, to our capital account in the agreed profit sharing ratio. All right. So now we are having two items to transfer to capital account, which is goodwill, and then we also have what? Revaluation. All right. So we're transferring to our capital account. All right, so we're going to be preparing the partnership capital, the partners capital account. All right. Now this is their capital account with their name attached to each column. All right, both on the debit and on the credit side. So the first thing we'll do in the capital account is to bring in their balances that was reviewed in the balance sheet. All right. So from our balance sheet, we have that the capital for Foodme is 10,000 naira. The capital for Remi is 8,000 naira, and then lastly, the capital for Titi is 7,000 naira. So we're going to be entering on the credit side. Okay, this is the balance that was brought forward. Okay, from the balance sheet, we are having 10,000. We are having 8,000, and then for Titi we have 7,000 naira. So we have brought in the balances. Okay, the next one we're going to be bringing in is our goodwill. Like I said, goodwill has a direct relationship or impact on the capitals account. Okay, now we're not told that goodwill is going to be written off. Okay, that means it's going to be retained in the books. Okay, so we're going to be retaining goodwill in the books of account. So I'll be entering goodwill. So for the first partner, our goodwill that was shared for him is 3,000 naira. For the second partner, we have 2,000, and then lastly for the third partner, we have 1,000 naira. Now we are through with goodwill, and the next thing we are going to be doing is the revaluation account. Okay, the value that was given or the value that was shared in the revaluation account will be transferred, because on the debit side, right, it will be transferred to their capital account. Okay, that's an increase for them, that's a benefit for them. Okay, will be shared to them, transferred to their separate capital account on the credit side. All right. So we're going to be having for revaluation. For revaluation, for the first partner, we are having 2,400 naira. The second partner, we are having 1,600 naira. And then for the third partner, we are having 800 naira. All right. This is it for revaluation. All right. So the next requirement after we have entered in our revaluation value for the capital account, the next requirement is that we are to note that a partner is retiring, okay? A partner is leaving the business. Are we there? A partner is retiring, a partner is leaving the business. So in this case, we're no longer adding, we're not bringing in money, but money is going to be going out in this case, all right? For our last video, we had that a partner was admitted, and then we had money coming into the bank account, right? Now, in this video, a partner is going out, so we are going to be settling that person, all right? And the person retiring is Titi, that is the last partner, okay? This person is retiring, all right? This person is retiring, so means her value is going up. Like I said, whenever we want to minus, we are counter entering. So we are going to be debiting her account with her total amount, all right? We're going to be debiting her account at total amount because she is retiring from the partnership, all right? So what we do for City is that we sum up all the value she have in her account, okay, in her capital account, and then we pay her off with that value, okay? We pay her off. It is, we are assuming in this case that we're going to be paying her totally. There are some cases where the business may not have all the money to pay off, and then they may have to maybe owe her for a while, all right, if there's an agreement like that. But in this case, we're not giving such an agreement, so we're going to, it means the business want to pay her off totally, okay? So we're going to be taking the total in her account, okay, which is 8,800 naira, okay? We're going to be paying her that money, and if we're paying her that money, it means value will be leaving the business's cash or bank account, all right? So we are assuming that a business operates a bank account in this case because we are giving cash and bank together. So we assume that the business operates a bank account. In other words, we're going to be paying her off through the bank, all right? So since she's leaving the business, we're going to be debiting her capital account, all right? We'll be debiting for Titi, not for Fumi. Fumi is still in the business, not for Remy, but for the person that is leaving, okay? And her total amount is 8,800 naira. Like I said, this only happened in the case where she is paid fully, all right? This only happened in the case where she is paid fully. In other words, there are times where the business may not be able to pay off that partner that is leaving. They maybe were not, the business may not be solvent enough to pay off that partner fully, all right? So they may be paying, they may transfer this amount to the loan account, okay, which we'll see in another video, okay? They'll be transferring this amount of capital to the loan account, and then they'll be paying off as from the loan, okay? They may even be paying her off with interest. All right, now we are assuming that the business want to pay her off immediately, or they want to pay her off at once, okay? That's the reason why I'm transferring all these amounts, okay, to through the bank account. That means we want to pay her everything at once, all right? Now after we have subtracted, it means her balance will be coming to a close, all right? So that, this means we are closing her account. So we're going to be having 8,800 for Titi. We are through with her. All right, so for the other people now, we now have to balance their account. All right, now we are through with Titi. The next thing is that we'll balance the account for the remaining two partners. All right, so for Remy, we are having 8,000 plus 2,000 plus 1,600, okay, and that's going to be giving us 11,600. So this is our balance carry down. All right, for this person Remi, we are having 11,600. Now Titi is no longer here, okay, so there's no balance for her. All right, and then for the first person we are having 10,000 because there's nothing here, okay, there's nothing on the debit side, so we're just transferring the entire amount as the balance, okay. We are having 10,000 plus 3,000 plus 2,400, which is 15,400. All right, so we are through with our balance carry down. So for the next year, after we have balanced our account, we'll be having a balance brought down, okay, a balance brought down of, for the first partner we're having 15,400 naira, we're having 11,600 naira, and then we are no longer having any value for the third partner because she has gone, okay, or we have settled everything concerning her.